Hello students, welcome. This week we are going to be covering Chapter 3. Chapter 3 deals with the double entry framework. Okay, and this is Chapter 3 for Accounting 1303, Introduction to Accounting 1. And we are using the College Accounting Textbook 23rd edition. Okay, so I'm just going to go ahead and provide a short overview of some of the key concepts in Chapter 3. It is your responsibility to read the entire chapter. The chapters are not very long, so please do take the time to read the chapter, review the different diagrams, the different pictures, the different examples that are provided. They're going to serve as guidance so you can be able to complete your assignments. Okay, so this particular chapter deals with the double entry framework. The first thing I'm going to start doing or start off by doing is introducing the T account. Okay, the T account is basically a method or a way to simplify accounting. Instead of posting the transactions directly into your journal, which we're going to do that in the next chapter, in the T account, we basically analyze the transaction and post it into individual T accounts. That's going to better allow us to view or visualize what is it that we're doing or recording. Okay, so the T account is called a T account because it looks like a T. Okay, there's three components into the T account: the title, the debit side, and the credit side. Okay. So every time that you're going to record transactions, you have to have one T account per account. Okay, so let's say you have cash, supplies, utilities expense, capital, whatever the case may be. You need to create one T account per account that you're using. Okay, so this is a basic illustration of a T account, and the examples that I'm going to be providing today in this presentation is how to post transactions to a T account. Okay? It's very important, and it really facilitates once we're more developed into just posting directly into a journal entry. Okay? When I used to work at a bank, I used to, my employees had issues visualizing what I was telling them. I would always go back and draw T accounts for them, and in a visual format, it's a lot easier for them to see it in a T account than in a journal entry. Okay? So it's just a different method of recording transactions when we're starting off in accounting. Okay, so we always have a title: cash, accounts receivable, accounts payable, whatever the account is, you're going to label it on top of the account. Okay, and then you have your debit side. If the account needs to be debited, that's where you're going to post it, and the right side is the credit side. Okay, so that's how it works. Okay, now I usually do not ask students to memorize stuff for my course, but in this instance, I am asking you that you learn, memorize. In order for us to succeed in accounting, you do need to know the normal balances of the accounts. That way, when you're recording journal entries or recording transactions per se, you know exactly what you need to do. Okay, so these are the normal balances of the different types of accounts. Now, it's up to you to know what an asset is, liabilities, owner's capital, revenues, expenses, and drawing are. Okay, what accounts fall into that category? That's your responsibility to also know. Okay, but once you know, and that will happen with time, what goes into each of the categories, you need to know if a category needs to be increased or decreased. What do I need to do? Do I need to debit it or do I need to credit it? And in accounting, that is the terminology that we're going to be using. Okay, cash is increasing. Okay, if cash is increasing, then I know that cash needs to be debited. Okay, cash is decreasing. I made a payment. Okay, so my cash is decreasing. If my cash is decreasing, I need to credit my cash account. Okay, revenues. Okay, revenues is the opposite. So your revenues increase, you're going to credit your revenues account. Your revenues decrease, you're going to debit your revenue accounts. So I'm just going to provide this to you. Make sure that you know the normal balances of each of the accounts. And basically, when I refer to as the normal balance, that is basically the side of an account that is used to increase the account. I'm interested in knowing if I need to increase any of these accounts, okay, what do I need to do? Do I need to debit it or do I need to credit it? Okay. Now, if you have an asset, an expense, or a drawing, okay, let me type this here: asset, expense, or drawing. Okay, those are increased. Okay, increase by a debit. Okay. So, and this is how I like to group them. Okay. So, even if you have an asset, an expense, I'm sorry, let me spell expense. If you have an asset, an expense, or a drawing, you always know that in order for you to increase it, you have to debit the account. Okay? So an asset is anything that you own, whether it be supplies, accounts receivable, inventory, cash, anything of that nature, equipment, land, anything that you own. If you want to increase your account, you debit. If you want to decrease it, then you would credit it. Okay? The expenses, anything that has an expense, utilities expense, postage expense, gasoline expense, rent expense, anything that is an expense is debited. Okay? You increase it by debiting. Drawing. This is when an owner of a business takes money out of the business. Okay, so I'm the owner of ABC company and I'm going to withdraw $1,000 for my personal use. So when I make a withdrawal or a drawing, I am going to increase that drawing account by a debit. Okay? Now, when in the contrary, when we have liabilities, owner's capital, and revenues, those are increased by a credit. Okay? So, let's say, for example, I purchased something on account. I owe more money. Okay? So I bought something and I promised to pay in a year. Okay? I have a higher liability, or my liabilities increase. When your liabilities increase, you're going to credit the account. Okay? The same thing with your capital. You invested money into the business. I put money, $20,000 into the business so I can get it started. I'm going to post that increase of my capital as a credit to my capital account. Okay? I generated revenues. I went out there and I performed a service. Okay? Let's say I mowed lawns. Okay? So I went out there and I did landscaping and mowed some lawns, and they paid me $5,000. Okay? My revenues are increasing because I performed the service. I went out there and did landscaping. Anytime you have revenues, you're going to credit your revenue account. Okay? So this is kind of a summary. 3 accounts are increased by a debit. 3 accounts are increased by a credit. Okay? So I encourage that at the beginning, when you're starting to record all of these transactions, you have this little diagram, and you can find it in your textbook. It's figure 3.3. You have it with you. That way, when you're analyzing transactions, you say, okay, my cash is decreasing. Okay, if cash is decreasing, then what do I need to do? Well, I need to credit my cash. Okay. My revenues are increasing. Well, then what do I need to do if my revenues are going up? Then I need to credit my revenue. Okay. I withdrew money from the business. What do I need to do? Okay. I need to debit my account. So on and so forth. Okay. So this diagram is very important. Always have it handy when we're analyzing transactions. Okay. So once you have this information down, you know it by heart, we can apply that to the accounting equation and the owner's equity umbrella. Okay. So this is kind of like the expanded accounting equation. Okay. And it gives it to you in a diagram form or a picture form in case you're a visual learner and you want to see what's going on here. I love this diagram because it tells you exactly what you need to do. Okay. So assets. If your assets are increasing, you debit. If your assets are decreasing, you credit. Liabilities. If your liabilities are increasing, you credit. If your liabilities are decreasing, you debit. Okay? So every time you purchase something on account, you're going to credit it. Every time you make a payment towards what you owe, it's a debit. Okay? And then all of the other items fall under the owner's equity category. So here we have your capital. Okay? So if your capital is increasing, you credit. If your capital is decreasing, you debit. Expenses. If your expenses are increasing, you debit. If your expenses are decreasing, you credit. Okay? And it's very rare that your expenses are going to be decreasing. Usually you pay your rent expense, your light expense, your utility expense, your phone expense, whatever the case might be. Every time, 99% of the time that you have an expense, it's going to be debited. The only time that you credit an expense account is when we have, or we posted something incorrectly and we have to make an adjustment. Okay, that is 1% of the time that we're going to be using it. Very rare. Most of the time, whenever you see the word expense, automatically debit. Okay, revenues, the same thing. Anytime you see the word revenue, I performed a service, I sold something, depending on what kind of a business you are, you're going to be crediting it. Revenues increase. Okay, they increase the money that you generate because you're performing a service or selling a good. Okay, once again, 99% of the time when you see the word revenue, okay, service fees, anything of that nature, money that you're earning, it's going to be a credit because you're increasing your revenues. Once in a while, maybe the customer paid you the wrong amount. You have to make an adjustment because you need to refund them because they overpaid or whatever the case might be. Once in a million, you're going to debit the account. But 99% of the time, when you have a revenue account, it's going to be a credit. When you have an expense account, it's going to be a debit. Okay? The same thing for a drawing. When your drawing is increasing, you're going to debit it. When your drawing is decreasing, you're going to get a credit. Once again, 99% of the time, anytime you see the word drawing, it will always be a debit, unless there's some kind of an adjustment that we failed to record an entry correctly or whatever the case might be. Okay? But this is another diagram that I would recommend that you have with you handy. That way you know, when you're doing accounting and you're analyzing all of these transactions, you have to be talking to yourself. Okay, what accounts are being affected? Are they going up? Are they going down? And then you can just look at the picture. Well, I'm paying my rent. Okay, so my rent expense is going to be debited. How do you pay your rent? With cash. Cash is an asset. So what happens when you pay your rent? Does your cash go up or down? Okay. In my world, when I pay my rent, my cash goes down. Okay? My bank account drops. So because my cash is decreasing, I'm going to credit my cash and I'm going to debit my rent expense. Okay? This is just an example of how you can use the accounting equation. This is also in your textbook. Make sure that you review all of this information. Now going forward in chapters 3 and chapters 4, there's going to be a lot of analysis of transactions. Analyzing transactions is the core of accounting. Okay? If you fail to do an entry or analyze a transaction correctly, then mistakes are going to be all over your financial statements. So it is very important that we were analyzing transactions, that we're analyzing them correctly, and that we're recording them correctly. Okay? So there's several steps when you're doing analysis of transactions. The first thing is we need to ask ourselves, what happened? You need to make sure that you understand the event that is taking place. Okay? Step number 2, you need to identify what accounts are being affected. Okay? After you understand what has happened, you need to identify the accounts that are being affected. You have to classify these accounts as either an asset, a liability, or an owner's equity, revenue, or expense. And you have to identify the location of these accounts in the accounting equation using the owner's equity umbrella, left or right, which is the diagram that I just showed you over here. Okay? So after you analyze, you have to figure out where am I going to plug these transactions. Okay? Step number 3, how is the accounting equation affected? So you have to determine whether the accounts have increased or decreased. You have to determine whether the accounts should be debited or credited. And you have to make certain that the accounting equation remains in balance after every single transaction. Okay? So, assets equals liabilities plus owner's equity. That is our standard accounting equation. Okay? And then your debits need to equal your credits for every single transaction. So this is what the steps that we're going to follow every time that we analyze a transaction. What happened? What accounts are being affected? And how is the accounting equation being affected? Okay. So make sure that we carefully read the chapter and that we understand the basic concept of debit and credit and the normal balances of the accounts. Okay. So now I'm going to jump over to an exercise from your end of the chapter. So you can locate this problem or this exercise in the end of chapter 3. Okay, I am going to be working on exercise 3.3. You are going to find that this exercise shows you how to analyze transactions and how to post them into a T account. Okay? So it's a very important concept that we need to make sure that we master to be able to move forward in the next chapter to doing this in our brains and then just recording these transactions into the journal. Okay? So exercise 3.3, this is an analysis of T accounts. So it says, Richard Gibbs began a business called Richard's Shoe Repair. Okay? They are asking us to create a T account for cash, supplies, Richard Gibbs capital, and utilities expense. We have to identify the following transactions by letter and place them on the proper side of the T account. And then we have 3 transactions that we have to record in our T account. Letter A says that we invested cash in the business, $6,500. Letter B says we purchased supplies for cash, $700. And letter C says we paid our utility bill for $2,700. So they're asking us to record these transactions in a T account. And then requirement 2 says we're going to foot the T account for cash and enter the ending balance. Okay? So they're being very specific here. Foot the T account for cash and enter the ending balance. Now, the terminology foot basically means balance. Give me the ending balance of this account once you're done posting all of your transactions for it. Okay? So, I highly encourage that either you take a picture with your cell phone of this particular exercise or that you pull it out in your electronic book so you can follow along. Okay? So, now I'm going to solve this. They ask us to create a T account for each of the accounts that we're going to be using. So I need 4 T accounts. I need cash, supplies, Richard Gibbs capital, and utilities expense. Okay? Those are the 4 accounts that we were asked to set up. Okay? Now, I'm going to go back to the exercise so I can record the first transaction. Okay? The first transaction says we invested cash in the business. Okay, so this is Richard Gibb, and he is opening a shoe shop. Okay, and he is investing money into his business. So he took out money from his personal bank account, and now he's going to put that money into the business account so we can start, operating. Okay, so what happened here? What 2 accounts are being affected? Well, I know that we are receiving cash because it says here that invested cash in the business. So that means that Richard gave me $6,500 for the business. Okay? So I have $6,500 more into the business. And now Richard has an investment into the business. His capital has grown because now he is the owner of the business. He's the one that put in the $6,500. His capital account is increasing. Okay? So, cash. Okay? What's happening to my cash? Do I have more or do I have less cash? So, I have more cash because money was invested into the business. Okay? So, cash is an asset. Cash is something that I own. Okay? Because I have more cash, I know that I need to debit my account. Okay? So, cash is going to be debited, and this is transaction A. Okay? So, cash is going to be debited by $6,500. Okay? Now, the capital account. Okay? Capital. Here's your capital account. Your capital account increased. So, when your capital increases, you need to credit it. Okay? So, my capital account is going to be credited $6,500. So, the steps in a transaction analysis. You understand the event that took place, which accounts are affected. We already identified it was cash and capital. Now, is the accounting equation in balance? Do your debits equal your credits? Okay? So I have a debit here of $6,500. I have a credit here of 6,500. Yes, I'm in balance. Okay, so I can move forward to my next transaction. You purchased supplies for cash, 700. So you need to identify the accounts that are being affected. Well, I bought supplies, so supplies is one of the accounts, and I paid my supplies with cash. So cash is being affected. Now you need to identify what kind of an account is supplies. Supplies is an asset, cash is an asset. Okay? So both of these transactions are asset accounts. Okay? So let's start off by recording. What happened here? You purchased supplies. So, supplies is an asset. Do you have more or less supplies? Well, it says that you purchased supplies, so that means I have more supplies. So I'm going to debit my supplies. Okay? So my supplies is going to be debited. This is transaction B. My supplies is going to be debited $700. Now, how did you pay for your supplies? With cash. Okay? So let's look at the accounting equation. Cash is an asset. Do you have more or less cash? Well, because you bought supplies, that means, and you paid with cash, that means you have less cash. Your cash decreased. So I am going to credit my cash. Okay? So cash is going to be decreased by $700. Let me just put it over here on top. Okay, so cash is going to be decreased by $700. Okay. So you have to, at the end of each transaction, make sure that you have one debit, that your debits and your credits equal. Okay. So I have a debit of 700, I have a credit of 700. So I'm good. My debits equal my credits. Okay. Third transaction. You paid your utility bill, $2,700. So you're paying your utility bill. So what are you paying? Your utilities. How are you paying your utilities? With cash. Anytime you see the word paid, it means that you're using up your cash. Okay? So, the first thing I'm doing is, what am I paying? I'm paying my utility bill. Well, what is my utility bill? The utility bill is an expense to the company. I have to pay my utilities. That is an expense. In order for me to be able to operate, I'm going to have all of these expenses. Utilities expense, rent expense, anything of that nature is an expense. So what's happening to your expenses? They're increasing. Okay? Your utility expense is increasing your expense account. So I know that I need to debit my expense account. So I'm going to go over here and I'm going to debit my expense account. This is transaction C. Okay. So, oh, sorry. So, utilities expense. I know that I am, like I said, I am going to debit my utilities expense because it's increasing. So that's $2,700. Okay. How did I pay my utilities? I paid them with cash. So what's happening to your cash? My cash is decreasing. I have less money now because I had to pay a bill. I had to pay my utilities. So cash is decreasing. Cash is an asset. Cash is decreasing. So I know that I need to credit my asset account. Okay? So cash is going to be decreasing, okay, by $2,700. Okay. So those are the three transactions that we were asked to record. Now they're asking you to put the T account for cash. Now, why are they only asking you to put the T account for cash? You only put a T account if you have more than one transaction posted. Because capital, utilities expense, and supplies only have one transaction, this is the ending balance on the account. Okay, so we don't have to put it because we already know we only have one transaction posted to each. That's going to be our balance. Now, our cash had 3 transactions posted. Okay, so now I need to figure out what my balance is. Okay, So I'm going to pull up my calculator. Your balance is always going to be posted on the side that it's the greatest. So is 65 greater than 2,700 plus 700 put together? Yes, it is greater. 2,700 plus 700, that's 3,400. So which side is greater? My debit side. So you're always going to put your balance on the side that it's the greatest. Okay? So my balance. Okay. So to get my balance, and I'm going to put the formula here, it's I'm going to get my balance on the side that is the greatest, which is my debit side, $6,500. I am going to subtract my credits, my 2 credits. Okay? So I'm subtracting my 2 credits. So what I'm doing here is I'm getting 6,500 minus 700 minus 2,700. Okay? And that leaves me with $3,100. So I want to know how much cash I have today. I have $3,100 in the bank. Okay? $6,500 was put in there as an investment. I spent $700 in supplies. I spent $2,700 in utilities. So that means I have $3,100 left over. Your balance will be the ending amount in your account. And usually, 99% of the time, your balance will be on the side of your normal balance. Okay? Most of the time, the balance is going to be wherever your normal balance is. Okay? So for the most part, whenever you have an asset, your balance is going to be on the debit column. Whenever you have a liability, your balance is going to be on your credit column. When you have capital, your balance is going to be on the credit column. When you have revenues, your balance is going to be on the credit column. When you have expenses, your balance is going to be on the debit column. And your drawing, your balance is going to be on the debit column. Okay? So that is how you foot. Getting the balance is what we call footing. Okay? And like I said, I don't have to foot these because I only have one transaction. Whenever you have more than one transaction, then you would foot it. Okay? So that is exercise 3 through 8. I hope this short presentation provided an overview of what a T account is. Very important, understanding what a T account is, the normal balances of your accounts. Make sure that you print this figure out from your textbook and you understand everything here, what increases and what decreases each of the accounts. You also print out your figure 3.2, which is the accounting equation. That way you know if you have an increase or a decrease for each of the categories, whether you have to debit or credit. Okay? And then whenever you're analyzing transactions, make sure you ask yourself these 3 questions. What is happening? Which accounts are affected? And how is the accounting equation affected? Meaning, is my assets equal liabilities plus owner's equity imbalance? Do my debits equal my credits? Okay? Remember, when we're reporting these, debits must always equal credits. Accounting is a balancing act. You must always balance your debits and your credits. Okay? So that is the end of this short presentation. If you have any questions, make sure that you either go visit me during my scheduled office hours, you call me during my scheduled office hours, or I'm always available. You can always send me a Blackboard message Monday through Friday, and I will respond. Make sure that if you are sending me a Blackboard message with a question, you include the question number and your attempted solution so I can be able to review what you're doing and provide the necessary guidance. Okay? So make sure that you read chapter 3 before you begin working on any of your assignments. And until next time, have a great day.